Welcome back to Great Quarter Guys, episode 62. I'm your host, Andrew Cox, senior retail analyst here at FreightWaves. It's been a 2-week hiatus since our last show. Been longer than that for Seth. We haven't been back together for 3 weeks, so I'm glad to have you back. Glad to be back in the saddle. And we're going to do a little bit of a different show today because the topics that we want to cover take a little bit more time. We want to distill them a little bit, so we'll take more of a conversational, open-ended question on a few topics. So there's been a lot that have happened since our last episode 3 weeks ago. So we're going to go through a few of those. One of them is we've had a stimulus bill passed. We now have more money headed into consumers' pockets. There was an article on Barron's that says that it's the strongest consumer backdrop in decades. So we're going to talk about what we think some of that money is going to go, what we think about the consumer backdrop, what it means for the freight industry. We're also going to discuss USX. We finally got some more information on Variant, this baby beast company within a company that they are brewing down in Atlanta. It's a very promising technology company that USX is bringing along. It's now, I think, up to 800 or 900 trucks or so. We've got some more light from CEO Fuller on that. So we're going to discuss that. And then also there was Bank of America and Wall Street in general has changed sentiment towards the trucking industry. We saw a lot of upgrades of trucking stocks last week. Talk about why they've gotten optimistic all of a sudden and give our expectations for the rest of the year and in the coming months. And then we'll also talk a little bit about where that stimulus money, where we think it might be spent. And then we'll talk about the Too Simple IPO. That has been some news that has broken over the last couple of weeks that Too Simple is gearing up for an IPO. They've hired somebody, a former Morgan Stanley banker, to kind of get ready for this. So we'll discuss what Too Simple is, what we think their impact to the market is, because they are likely going to be one of the first to bring autonomous trucks to the market, and it doesn't seem that far away. They're planning on a test run without a driver in 2021. So very exciting stuff on the autonomous trucking side of things. Seth, how are you, my man? Thanks for joining us.
Good, Andrew. Good to be back. It's been a little bit of a hiatus, like you said. Excited to talk about all this stuff today.
Yeah, exactly. Let's jump right in. So Barron's and Jeffries say the consumer spending boom, it's coming, and they offered a bunch of ways to play it. We're going to riff on a couple of those ideas, but they say it's going to be we have the strongest backdrop in consumer in decades. It's just around the corner, and there's a lot coming forward. So Seth, let's just talk about it, man. What do you think about the stimulus checks coming through? May hit as early as next week. What are you expecting to see? What kind of bounce back are you expecting to see from that?
Yeah, I mean, it seems hyperbolic when you hear statements like that, but then when they actually show you the numbers, it's not that crazy. So what Jeffrey's economist and some of their stock analysts said was, they're forecasting personal consumption expenditures, PCE, up about 7.5% year on year in 2021 and up about 4 or 5% in 2022. And that would give you the best 8 quarters of growth since 1990. So call it, 30, 31 years. And you've heard a lot of people tossing out this roaring 20s analogy lately about what things are going to be like when it comes back. And I think that's why we got that booming stock market. It didn't make sense 3 to 6 months ago. Why are stocks going crazy to the upside, and yet everything's so terrible out there? And I think we're starting to find out. You look at fourth quarter earnings season, and earnings were actually, I think, up 12% year on year on average, which is like definitely not a recession. And sort of cyclical areas of the economy are picking up. We've had inflation worries in the market, and you generally don't have those unless economic growth or activity is going to pick up. So I think that's what's coming. The only question, again, is just that to key on is that for trucking in particular is that goods versus services question. And, a lot of these stock picks that Jeffries throws out, they make sense to me. We can talk about, I want to hear your opinion on that too, but they think that some of the best positioned stocks are a lot of the services. Particularly, they hit on Uber and Lyft, which makes sense to me. Like everybody's going to start going back out to bars and restaurants again, particularly with the spring and the summer upon us on top of the vaccines. I know, like personally, I'm itching to kind of do that sort of activity as soon as it's safer. And I think most people in Texas is fully reopened with no mask, and so is Mississippi. So that makes sense. And then they also talked about, Southwest Airlines. Made sense to me because they're talking about domestic travel picking back up before international, right. And they hit on a few restaurants and stuff like that. What was your opinion and take on the overall piece?
Well, the Southwest one is in particularly kind of interesting to me. I don't know if you read Bank of America's COVID and the consumer report from last week. Actually, of course, you did. You did it during the PPI. But did you see they were talking about how the oldest generations have just exploded when it comes to airlines, but they haven't exploded when it comes to lodging? I thought that was a great insight that they made, that they think the older generations are actually getting on airplanes and going to visit family. So I think domestic airlines, especially Southwest, that has a lot of exposure. That's a great play. I wanted to talk about the services spending, because this is another thing that was in that Bank of America note. They talk about this often, the difference in service spending between Georgia and Florida, or Florida in particular, who have pretty lax COVID entertainment rules, and they've seen really strong spending in entertainment there. So I think that people are just itching to get out and go to the bars and I went to a concert on Friday night, socially distanced with Pod, and it was just amazing. Like, I just felt great to hear live music for the first time in forever. Probably spent more money than I should have. And I think most people will do that when they go out. I think that people are just itching to do it. So I think services make a lot of sense. I also think when it comes to things that we didn't buy in 2020, I think apparel is also set for some strong gains, especially the value people, the value guys, off-pricers, TJ Maxx, Ross. I know we've talked about those offline in the past couple weeks. I think those are all set to bounce back, and as are the luxury ones, because you have we've talked about that on previous episodes. This dichotomy between the bottom half and the 1%, or the richest people in America, has probably even widened because of this recession and the pandemic. So I think that the luxury names look good. I know you've been owning Goose Island, the $15,000 jackets they make.
Well, Goose Island,
not
I
quite
think, is
that
the
much, but they are
IPA.
great. I do want one. I'll be honest. But I think luxury names are also
Canada
going to
Goose.
have a good deal. Canada Goose, right? Now I'm thinking of
Goose
Stone
Island's
Island.
the IPA. Yeah.
Yeah. Oh no, but Stone Island. There's also Stone Island. You ever seen those coats?
No,
And it's actually,
I
they're
don't
like
know.
really expensive. And there's this thing in the streets of London that apparently this is street street rules. Apparently, is what my British friends tell me, is that if you're wearing a Stone Island jacket, you're always ready to fight at any time, because apparently the jackets cost so much that you have to defend yourself from wearing them. It's quite a thing. But you just see people randomly fight because they're both wearing Stone Island jackets. But anyway, let's bring it back to freight. What do you think? We'll get to this question. We were going to get to it later, but let's go to it now. What do you think the stimulus checks are going to be spent on? I'm thinking apparel. And I think services. I think people are going to be putting away some of this in plans for those fall and winter vacations. But what do you think?
Yeah. So my overall sense is, if you look at what it got spent on last time, it was basically got spent at the big box stores, the Walmarts, the Targets, the Costco's, on massive grocery runs. It also got spent on furniture and things for the house, like at Home Depot, and you're redoing your house. And then it also got spent on the stock market, quite frankly. A lot of it, I think, went into there, because consumer balance sheets are actually flush right now. A lot of people didn't need this extra cash that they're getting, but they're doling it out nonetheless. And it's the government's balance sheet that's taking on all the additional debt and strain from this. I do think that in general, your apparel thesis makes sense to me. When you start getting out of the house more and the weather warms up, and you start seeing people again, you want to upgrade your wardrobe, get some new clothes. Probably also in the last year, a lot of people have just been staying in the house and wearing, athleisure stuff all the time. So that makes sense to me. But in general, I would say I think that a lot more of this is going to go towards semi-services. So in other words, like the easy entry-level services. So those restaurants that you can dine out at, maybe not movie theaters, but I think you'll start to, like, on the far right end of the spectrum, you kind of have movie theaters and international travel and stuff like that. I think it'll kind of go into the services bucket, sort of that mid-level services bucket. It's like an easy introduction back to normal life. That would be my guess. Much more of a mix, but I do think trucking will still gain its fair share of goods. Like, anytime people get money in their pocket, they do spend it on goods, although it's hard to argue that maybe you haven't upgraded your TV, or you and I look at that retail data. It's been remarkably similar for about 50 weeks in a row. Although now we're starting to see those green shoots, like you mentioned. I don't think you mentioned airline travel spend is up 400% or 300%, 4x year over year for older Americans. So I think that's a sign of things to come.
Yeah, I do agree with you. I think a lot of the electronics, a lot of electronic spend and the home improvement spend, a lot of that was pulled forward. So I don't see a lot of that happening. It is remarkable how similar those spend has been. I mean, I thought that we'd see home improvement fall off or electronics fall off, but we haven't seen it yet. But I just have to think it's coming. Let's move on to US Express. So we got some new data on Variant. This is their technology platform that's focused on utilization, focused on driver turnover, and focus on reducing costs and inefficiencies. Seth, you want to go over a couple of the new, some of the new data points that we got and information on Variant?
Sure, and we our passport research team wrote a paper on Variant back in December of last year, so feel free to go check that out. But Variant is kind of fascinating because it's a huge bet. I don't want to say it's binary because it's not, but it's an aggressive, bold bet by U.S. Express where they want to go and take that over the underperforming over the road trucks. Where they have a lot of high turnover and basically do a wholesale transition to this model with these sleek trucks driven by apps and technology, led by experienced drivers, where you're kind of rerouting that freight network and digitizing it. And it's essentially supposed to be the truckload way of the future. And if they can pull this off, and they seem to be, one of the early leaders in this front, and they're investing a lot of money in this, it could mean really big things for U.S. Express, both as a company and as a stock, because one of the things that Eric Fuller talked about, and I don't recall whose conference it was, but it was a great article by John Kingston, our writer on the website. So go check that out. But Eric Fuller, the CEO, noted that it has the potential to drive their operating ratio, or OR, from 95 to 100 range, sort of at the upper end of the truckload peer set. He thinks over time that it's possible that it could get down to the high 80s or low 70s, like some of the the Knight Swifts or the Old Dominions, some of the best in class sort of trucking and LTL players, which obviously would just be enormous for the company. But in a bigger sense, this may be the model of the future in terms of truckload. So I think it's just really interesting. And what happened was, so they started out a little bit. They only redid, as of December, they'd only converted like 15% of their over the road fleet, which is something like 4,000 or 5,000 trucks. But now they're making their way. They've got about double that, about 1,000. And so, they're getting down the road in this transition, and they offered up a lot of data. Specifically, the data that's really enticing about this is, I think it's the average truck gets 30% more miles per week with 30% less accidents and 70% lower driver turnover. And when you add all that up, you can imagine, both the financial implications and just sort of the human capital impacts that makes on their organization. They're huge.
Yeah, unfortunately, we don't. It's funny the way that Ramsdell talks about this. The guy that's running the Variant project, they've based it in Atlanta, right across the street from Georgia Tech. Apparently, it's becoming quite a pipeline for them for talent, which is good. Chattanooga is not exactly the premier destination for engineers at the moment, but getting better. But we don't know exactly how they're doing it. He thinks that truckload is solving this very complex math problem at all times, but there are three things that are kind of the goals of the program, aren't they? And I can't remember the exact. There's reduce driver turnover, increase utilization, and what's the third?
Freight selection and network routing optimization. So that kind of goes hand in hand with utilization, but those are kind of the three sort of key benchmarks for what they're trying to do. And it was interesting because how much of the trucking industry that both we hear from and we talk to, how many people do you think actually consider trucking a math problem? Not many that
Yeah.
we come across. So it is a very sort of interesting take that he throws out there.
Yeah, I love it. I mean, it is an old school company with taking on a new school project, and it's only growing. I think, as you said, they're at 900 or 1,000 trucks now. I believe they've set their goals on 1,500 by the end of the year, but they said they'll probably blow past that. So this could eventually, we don't know much about Variant yet. Sadly, they're still keeping a lot of it under wraps as they make it better and scale it. But this could eventually be the AWS for US Express, in a way that they eventually market it out to other trucking companies, other carriers to use. So this could be eventually the business if it ends up panning out to be what US Express expects it to be. I think there was in that article that John Kingston wrote, there was an analyst that mentioned that this
Robbie
by late
Shaker.
Morgan Stanley. Yeah, it was Robbie, was it?
Yep.
Robbie at Morgan Stanley said that if this variant initiative is successful, the stock could be worth at least $15 on its way to 70. The
Yeah, and
stock is at $10 right now.
Yep, yep, exactly. So, I mean, it's worth keeping your eye on, and I think you can understand if they do get out to an early lead, and this is as promising as they kind of hope and say that it is. You probably don't want to divulge too much data because you don't want everybody to copy it
Right.
at the same time. So, I think there's maybe some of that at play as well.
Yeah. Precisely. All right. So one more here before we get on to Too Simple. This is Bank of America and Wall Street in general, kind of taking a more optimistic stance on the trucking sector. They upgraded a swath of trucking companies, including U.S. Express, got a double upgrade from underperform to buy. Seth, you want to walk through a couple of their reasonings, and we can discuss what we think about them?
Yeah, sure. I mean, we've kind of hit on a lot of this over the past couple of weeks and months, and I actually was kind of on board with them. Basically, the way things were a couple months ago, before that huge winter storm hit in mid to late February, was everybody was kind of thinking, well, here we go, we're getting what is it, 50,000 trucks a month in new Class 8 orders, which is 2.5 times replacement levels, and it's the biggest truck orders in 40 years of record keeping. And you've got these $3 spot rates, and it just seems like here we go again. It's all over, especially once the second half of 2021 comes and everybody gets a vaccine and that services spending happens. And what has gradually happened, and where I agree with Ken Hexter, the analyst here, is a couple things changed. One, it seems like the overall economic growth projections are going to be better in an absolute sense, which means even if that mix shift comes, then it may not be so bad for trucking, just purely because the economy is growing at such a high level. I think that's one thing. Two, even with these new truck orders, you still can't see them for all these reasons. The drug and alcohol stuff, the trucking schools are not operating, and then you're not raising wages by 10 or 15% if unless you're having trouble finding drivers. And then I think thirdly, that snowstorm hit, and basically it created pent-up demand. It's going to whack everybody's first quarter earnings, which he talked about in the note. Basically, they're cutting earnings estimates for Q1 by 10 or 15% on average. And JB Hunt commented that was the likely degree it was going to hurt them in the first quarter at a conference recently. But on the other hand, they're raising the estimates for the full year and then for 2022 as well, because basically what this did is it took what was already a tight capacity situation, and it just made it super tight where we're back up to 27, 28% tender rejections again. And you're creating peak season conditions in what is normally a dead part of the year heading into produce season. So basically, right, you have all these factors coming together, which is basically, in short, what my view is too is, hey, maybe this runway for truckload is going to last through all of 2021 rather than just halfway through.
That's what it seems like. It seems like everybody that was kind of calling for a second half correction in rates or an easing of the market, it was kind of priced for perfection. It needed a lot of things to happen for that to occur, and the market was so imbalanced already with contract tender rejections at 18 or 20 at any small catalyst that takes any drivers off the road. It has an outsized impact. Like the winter storms. Yes, the winter storms only lasted for 3 or 4 days, maybe a week, but the freight that piled up is taking much longer to work through given the imbalances that were already in place.
Yeah, now you can make the case with the port congestion. You start adding all these things up, the port congestion that just continues unabated. I wrote an article about, maritime rates. You have this nightmare situation where if you're a shipper on the ocean, you're basically choosing, do I pay 70% more for contract capacity on the ocean, or do I pay 300 or 400% higher year on year for in the spot market? Either way, that's not a good choice. And so you've got all that. Yeah, you've got all that. And I'm kind of coming around. I think we said we kind of disagreed with the pent-up demand consumer thesis, but I'm starting to believe it more just because I'm seeing it play out in the data, where maybe that is actually going to happen. And so if it does, like I said, it's not going to be a bad thing for truckload, even if, because the restaurants still need all the stuff that gets served there needs to be on a truck. Although, the classic example I heard, Kyle from K Ratio, I thought this was a good thing. He said, think about it this way. when you spend $100 at a restaurant, maybe you get 2 steaks and a couple glasses of wine. And he's like, but when
Yeah.
you go to the grocery store, you get 30, 40, 50 items, and think about the freight implications of that. So there's no question there. And I thought that made a lot of sense. And there's no question it's a drag, but to what degree is hard to say.
Yeah, for certain. I think we should just move on to Too Simple because we've got only 10 minutes left. So this is a big conversation coming up, or a big company coming down the road that everybody's very excited about. They're not going the SPAC route. We had thought late last year, some rumors had come about that Too Simple may be looking towards the special purpose acquisition company that almost every other company has taken the route of in their position, which is a company that's taking on a huge market. It's a very complex problem to solve. That takes a lot of money to solve, but right now they're not generating all that much revenue. So, Seth, you take the lead on what is Too Simple, and then we'll jump into what we think are the implications of an autonomous future in trucking.
Yeah. So given that we're a little bit shorter on time, I mean, so what I would say is Too Simple is the leading autonomous trucking company, and what does that actually mean? Basically, they have a software system called the Autonomous Freight Network, which is it's a combination of cameras and LiDAR and software and that sort of thing, retrofitted on existing trucks right now. But it's also a system of terminals and physical actual infrastructure out there in the United States. And basically, what they're doing is they're trying to tackle the long haul open over the road portion. They're not going to try to do the last mile. That is likely to be done by human drivers, maybe forever, but at least for the foreseeable future. Really, where they're tackling is they're planning their network, for example, to go from Phoenix to Tucson to the Texas Triangle in stage one of their network, which makes sense because it's kind of open roads with perfect weather all the time, or most of the time. Certainly, we saw that with the blizzard in Texas, but for the majority of the time, those are the easiest conditions to drive autonomously on. So that's kind of the deal. They're the leaders. They're almost like a half Chinese, half U.S. company. Offices in San Diego and Beijing. They've got 800 employees and 70 trucks right now. They're going to do a traditional IPO through Morgan Stanley. We thought this would be a good thing. It's reported to come any day now. We should get the S1, the prospectus, and then in the next couple of weeks we should get the pricing. So.
Yeah, so this is a really interesting company because not only because of the ties split between the two largest trucking markets in the world, the U.S. and China, but because they've got a crazy team together all of a sudden. They keep racking up partners after partners, very reputable names from on the hardware side, whether it's NVIDIA or the trucking partners Navistar. Well, they've got in this autonomous freight network, they're using U.S. Express as a broker. Leasing trucks from Penske. So they've got a lot of big names around them. They've also rolled out recently a new board of directors that have strong ties to Washington that is supposed to be, help them bridge that gap because they have been marked by one of, I can't remember who marked them, but one of the government agencies marked them as something that may need to be further looked into simply because it has such tight Chinese ties and autonomous technology is seen as huge for the Defense Department. But I think what this autonomous freight network is kind of a recent development. I think it was announced eight or 9 months ago. And Too Simple's CEO, Cheng Lu, said that our destiny is tied to the adoption of the autonomous freight network. So I think this is the way that they go to market. This is the way they introduce people to it. And we're still, a lot of the details are unclear on how they're going to monetize it. We know it'll be some sort of subscription base, but this is something that you and I were talking about offline, that it seems like a lot of people that are working on autonomous vehicle technologies don't really know exactly how they're going to monetize it yet. They're just solely focused on making sure that it's safe before they bring it to market, which is a good thing, right?
Yeah.
And on the last mile drivers, this is something that is an interesting discussion because Too Simple has made it a point to say that they're not displacing drivers, they're not going after taking away the jobs from drivers. Rather, they're trying to make the job more enjoyable for drivers, meaning keeping them closer to home, not keeping them on the road for as long. So building these nodes where autonomous trucks can bring and drop freight, basically drop ship yards and drop and hook yards, where then drivers, owner operators, or carriers can come and pick up those and take them to their final destination. It seems like a system that makes a lot of sense, but I have more questions than I do answers on this one.
Yeah, I mean, so I think what they're trying to say is the net impact to the actual driver pool is just going to be minimal, and it'll just be transitioned where maybe long haul over the road driver that population, does go down by a lot, but then it feeds over into that short haul. So. As the CEO described, you're likely not, again, not anytime in the near future, going to have those sort of distribution center or fulfillment center to storefront. Those moves are to customers' homes. Those are still going to be moves done by short haul. You're basically, the truck driver population is going to transition to short haul and final mile trucking, because and it's particularly when you think about Amazon and being able to traverse the country in a truck in 36 hours because there's no hours of service limitations. It's just going to, and as customers' perceptions and preferences in terms of delivery times just keep going shorter and shorter, it makes sense that a lot of those jobs just get reallocated.
Yeah, I mean, I was thinking about autonomous vehicles and how they solve so many problems on both the carrier and driver side, and eventually, I won't say they solve customer problems because it's not a problem to get our stuff in 2 days, but they make it even better for us to be able to get things faster and faster. But when it comes to drivers, the biggest problems we always hear about are it is just a tough job, the long, difficult hours of sitting, not being able to. It's a truck drivers unfortunately are typically not the healthiest of people because they can't get fresh food. It's a tough job. Long haul truck driving is, and home time is a big thing. This is something that Variant and US Express has made a point of emphasis, that at home time, that people were turning over at US Express not because they didn't get home time, but because they were missing the big events. And I think these type of systems, autonomous vehicles, allow you to spend the night at home every night, or spend the night at home most nights for a driver. And I think that is a huge benefit. And then on the carrier side, you're having less turnover. One of the biggest costs for US Express and for most carriers is driver turnover. You have some data on how much it costs per driver to hire. It's unbelievable. And then wages and insurance are also two rising costs at trucking companies that can be remedied and mitigated with autonomous trucking.
Yeah, I mean, we're running short here on time, but the company themselves thinks they can reduce the overall cost, even with the added cost from the software system, by 30%. And if you think about an industry that's capital intensive with low margins, a 30% improvement in profitability is a big, big jump. So.
Yeah, absolutely. I mean, what is it? 30 or 40% of the per mile cost is labor, and then eventually these trucks are going to go on high. Yeah, thereabouts, and then the next biggest piece is gas, and those eventually we have hydrogen and electric and other forms of gas on the way that may be cheaper. This all of a sudden becomes a much more attractive business. That's something that I take away from autonomous vehicles and electrification of the fleet.
Yeah, I've thought a lot about that issue over my years that I've been in trucking now. But I guess I agree with that, at least initially. The argument is that longer term, if the barriers to injuries aren't there, that you see a rates collapse as more players move in.
Right. I guess that's going to be the answer here, is like whether Too Simple has a model that's affordable for owner ops to be able to be a part of, or if it's going to be something that only the biggest can be a part of. I know, speaking back to Variant and it's not Max Fuller. Why do I always call him Max Fuller? Max is the
Eric Fuller,
father.
yeah.
Eric Fuller,
Yeah.
thank you. And Eric Fuller thinks that consolidation is around the corner in the trucking industry, that we're not going to have so much segmentation moving forward because of technology. So it's going to be interesting. I mean, maybe go ahead. We got probably 90 seconds. Go for it.
Yeah, no, I was just going to say, I mean, we can get in, we'll probably get back into this topic because the prospectus should come back out and we'll know a lot more. Like, people don't know a lot about this company, including us. We've done, several hours of research, but we still don't know a lot. So we'll know a lot more. But I do think one of the inevitabilities is a lot of people think there's going to be a concentration of that truckload market share as autonomy comes, which makes sense to me. And Eric Fuller thinks it's going to condense down to basically 20 to 25 major players.
Yeah, 20 to 25 major carriers, probably only a handful of autonomous trucking companies that end up making it. I mean, there was a dozen or so when I first got to FreightWaves back in the beginning of, or the end of 2018. But Starsky didn't make it to the next funding round. Ike got acquired by Neuro. We have Uber's division that got acquired by Aurora. So everybody is consolidating or not making it to the next funding round. So I guess that's the reason why we think and we believe that Too Simple is leading the pack, not only because the technology keeps coming, but But that's all the time we have. So thank you, everybody, for listening. You can get all of our stuff on Freightcast, one feed with all the FreightWaves TV. You can go there to find everything. We'll see you next time.